Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, the Challenger and the Guardian go head-to-head on £20,000 on day one. Why lump sum investing beats drip feeding your I.S.A. every single time. Let's get into it.
Let me put this simply. If you have £20,000 sitting in a current account earning 0.1%, every single day you delay investing it is costing you money. The evidence says lump sum beats drip feeding 2/3 of the time.
And 1/3 of the time it doesn't. Oil is at $105 a barrel. The OECD says we're the most exposed G7 economy to the Iran conflict, and consumer confidence has collapsed. You want to throw 20 grand into that?
I want to invest 20 grand into that. Yes, because markets have always climbed walls of worry. There's never a comfortable time to invest. That's exactly why people end up with £8.2 billion sitting in current accounts earning nothing every March.
But the Vanguard study everyone loves to cite averaged across decades of mostly rising markets. It doesn't tell you what happens when you lump sum into a market that's already pricing in a geopolitical crisis.
Actually it does. That's what 2/3 of the time means. It includes wars, recessions, crashes. The study covered periods that included the Gulf War, the dot-com bust, 2008, COVID. Lump sum still won.
One on average. But we're not investing on average, are we? We're investing in March 2026, with a specific set of risks that are genuinely unusual.
Every single year someone says this time is different. That's the behavioral trap nobody talks about, the belief that right now is uniquely dangerous, so you should wait. It's just loss aversion wearing a sensible hat.
Call it what you like, but the downside protection of spreading your investment over 6 months is real. The cost of that safety is roughly £620 in expected returns. That's 3%. I'll pay that insurance premium happily.
£620 you're giving up for the psychological comfort of feeling cautious. And that's the average cost in most scenarios. You're paying even more because markets tend to rise while you're drip feeding.
And in the scenarios where markets fall 15% in the first 2 months, which is entirely plausible right now, the DCA investor is buying cheaper units while the lump sum investor is staring at a £3,000 loss wondering what happened.
A temporary loss. If your time horizon is 5, 10, 20 years, that initial drawdown is irrelevant. You're optimizing for how you feel in month 2 instead of where you'll be in year 10.
It's not irrelevant if it causes you to panic sell. And real people do panic sell. The average equity fund investor underperforms the funds they hold by about 1.5% a year because of badly timed entries and exits.
So your argument for DCA is that people are bad at investing? I agree with that. But DCA doesn't fix bad behavior, it just delays the point at which you're fully invested and fully exposed to those same emotions.
It doesn't delay it, it eases you into it. There's a meaningful psychological difference between watching your full £20,000 drop by 10% and watching a quarter of it drop by 10% while you still have dry powder.
Sure, but here's what DCA believers ignore. Once you've finished drip feeding, you're in the exact same position as the lump sum investor. All you've done is spent 6 months getting there, probably at higher average prices.
Probably. Not certainly. And in a market where gilt yields are spiking, where the Bank of England is caught between inflation from oil prices and a slowing economy, probably isn't good enough for me.
The real cost of waiting in 2026 is higher than you think. While you're drip feeding, that uninvested cash is earning essentially nothing. You're not just risking underperformance, you're guaranteeing a drag on returns.
Not if you park the uninvested portion in a money market fund yielding 4%. A sensible DCA plan doesn't leave cash earning 0.1%, that's a straw man.
Fair point on the money market fund. But you're still likely underperforming equities over that period, and you're adding complexity and transaction costs to something that should be simple. Put money in, leave it alone.
Simple isn't always smart. Look, I'll give you this, if someone has a 20-year horizon, low anxiety about volatility, and genuinely won't check their portfolio for months, lump sum is mathematically optimal. But how many real people fit the description?
More than you'd think, if they'd stop reading headlines about oil prices and collapse. The problem isn't the strategy, it's the financial media convincing people that the sky is always falling.
The sky isn't always falling, but sometimes it does actually rain. March 2026 has genuine structural risks that aren't just noise. A DCA plan that invests equal amounts on the first of each month for 6 months is a perfectly rational response to that.
You know what's also a rational response? Accepting that you can't time the market, that uncertainty is the permanent condition of investing, and just getting your money working on day one.
DCA isn't market timing. Market timing is I'll wait until things look better. DCA is I'll invest all of it on a fixed schedule regardless of what happens. Those are fundamentally different things.
They're different in intent but identical in outcome. You end up with less money invested for longer. Whether you call it caution or timing, the maths doesn't care about your motivation.
The maths also doesn't care about your sleepless nights. If DCA gets someone to actually invest their full £20,000 instead of leaving it in cash because they're terrified of a lump sum, it's done its job.
On that we agree, the worst strategy is not investing at all. But let's not pretend DCA is the smart move. It's the comfortable move, and there's a 2.3 percentage point annual gap between comfort and optimal.
And there's a much bigger gap between optimal and what people actually do when they're panicking. I'll take the strategy real humans can stick with over the one that wins on a spreadsheet.
My final point, the I.S.A. deadline is April 5th. Every day your £20,000 sits uninvested is a day of returns you never get back. The best time to invest was yesterday. The second best time is right now, all at once.
And mine, invest all of it, yes, but invest it over the next 6 months on a fixed schedule you set today and never deviate from. In a market this volatile, the £620 cost of sleeping at night is the best money you'll ever spend.
The Challenger, The Guardian, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.